So when we look at sub-Saharan Africa as a whole, I mean, ex-South Africa, we're starting to see very strong economic growth that is coming through. In fact, it's expected that we could see growth of around 5%. And this is because there's not a lot of exposure to those troubling economies and troubled economies such as the ones that we see in the Eurozone. Is 5% anything to really get ambitious and happy about?
Well, I think if you look at the overall outlook for the bigger countries, if you look at Europe, I mean, they're expecting contraction there. I think they're looking at, I think it's the States looking at about 2%, 2.1%. So I think 5.5% is great growth. And again, coming about from the fact that they've reduced their sort of exposures to Europe. You know, South Africa has pretty large exposures or exposure to the European markets. They've shifted away from the Africa side. I think the IMF report says that they've shifted away from sort of two-fifths of their export market into Europe into 1/5, and they're looking at the emerging market parts of it. You know, China is a great export country for them.
So we're talking about this kind of resilience, and we keep also saying that, you know, one of the biggest criticisms within Africa is the fact that we don't see enough intra-Africa trade. That is starting to grow, and it seems that we still very much focus on what we see in Europe, but we're starting to diversify even into the likes of Asia, and of course China being also a very key partner going forward.
Yeah, absolutely. There is a fair amount of the Africa stuff. I mean, a lot of it is certainly sub-Saharan Africa is imported from South Africa. So the dangers there are that they might start importing some of the inflation from South Africa. If we look at it from the sort of cross-border exports between Tanzania and Uganda and Kenya, there's not enough of that. There's probably more of that is required. Those countries still tend to look offshore for their growth areas. And you can't complain. If China's got growth rates of 8.2%, that's where the demand's going to come from. If you look at North Africa, for example, you know, a great export country for the tea for Kenya is going into North Africa. So if you look at North African growth, it's also very promising.
Let's also touch on what we've seen coming through from Ghana. IMF still expecting growth of 8.75%. That's actually higher than what we see in China. But the truth is we've seen a cedi that is depreciating. We've seen a 100 basis point interest rate hike in that country. We're worried about inflation pressures. Do you think that the IMF is actually getting these numbers right?
I think it's oil-led. I think if you look at the oil producers through Africa, all the countries are showing fantastic growth. You look at Angola, I think they're also in the 8%, if I'm not mistaken. So, you know, it's great growth for all the sort of oil exporters. So it's built around oil exports. I mean, if we see a lower oil price, then you might see it impact on those numbers. My concern for Ghana is that it's really built around this high sort of weighting on the oil price. The oil production in Ghana is lower than was anticipated. So I think that might be a little bit on the high side, but you know, I mean, even if it's high at 8 3/4 and it comes out at 7.5%, 8%, it's still fantastic.
Absolutely. We've actually seen quite a few rate hikes across Africa, which is interesting because India just cut rates by 50 basis points. Uganda being another central bank that actually hiked interest rates. What is your sense on that? Because they recently actually kept rates unchanged and also cut since the beginning of the year.
I think they probably cut too early. I think the Kenyan model is the way they're doing it is probably correct. The Kenyan model is holding pretty firm. Even though inflation and food inflation is coming down, they're holding rates where they are. I think Uganda, because they hiked so much when they did hike 400 and 300 basis points at a time, they're under pressure politically to cut. I think the cut was a politically driven decision and not an economic one. And now the economic decision is coming back with a hike again by 100 basis points last week.
So we're seeing a bit of worry coming through in Kenya because we've seen an increase in those kerosene, petrol prices, diesel prices coming up quite a bit. Inflation perhaps looking slightly sticky because of this issue. Is this a concern for you?
I think the feeding of that onto the food prices is probably the concern, but not a great concern. I think they're doing a lot of good things there. I think the currency is holding stable. The stronger currency impact, the lag of that is still to come through. So the benefit of that is coming through in the food prices. I think generally it's looking good for Kenya. I think it's looking good for the region. If you'd asked the same question 6 months ago, the East African region was looking pretty dire.